Sharia and securities trading. The Islamic banking and finance movement that developed in the late 20th century as part of the revival of Islamic identity sought to create an alternative to conventional banking that complied with Sharia, Islamic, law. Following Sharia, it banned from its practices riba, usury, which it defined as any interest paid on all loans of money, and involvement in haram, forbidden, goods or services such as pork or alcohol. It also forbids gambling, maisir, and excessive risk, bayu al-gharar. This meant that not only were interest-bearing loans, accounts, and bonds not allowed, but many financial instruments and activities common in conventional financial markets have been forbidden by most Muslim scholars because of their connection with maisir or gharar, and also sometimes because they involve payment of interest. These include margin trading, day trading, short selling, and financial derivatives such as forwards, futures, options, and swaps. This, however, has not stopped the Islamic finance industry from using some of these instruments and activities, and their permissibility is a subject of heated debate. While they often involve more risk than other investments and are used by speculators, they are defended as having useful economic functions. They are used in a large number of financial procedures, help manage risk and volatility, among other things, and provide incentives for employee productivity and innovation. Scriptural basis. The Quran states in Ayat 2-275 that Allah has permitted trade and forbidden usury. But not all trade is allowed in Islam. The Quran prohibits gambling, maisir, games of chance involving money. While the Quran does not specifically mention gharar, risk, several ahadith prohibit selling things like the birds in the sky or the fish in the water, the catch of the diver, or an unborn calf in its mother's womb. These have been called bayu al-gharar, literally trading in risk, defined as sales in which gharar is the major component. Jurists have distinguished between this kind of forbidden gharar, and gharar considered minor, yasir, and so permissible, halal, but disagree, according to at least one source, Abu Umar Farooq Ahmad, over what constitutes each kind, and have not agreed on an exact definition of the meaning and concept of gharar. The Hanafi and Shafi madhab, schools of jurisprudence, define gharar as that whose consequences are hidden. The Hanbali school is that whose consequences are unknown or that which is undeliverable, whether it exists or not. One modern scholar of Islam, Mustafa al-Zarqa, defines gharar as the sale of probable items whose existence or characteristics are not certain, due to the risky nature that makes the trade similar to gambling. Instruments and services. Commonly used financial instrument and practices that are often considered haram are forbidding. Options, futures and other derivatives are generally not used in Islamic finance because of the prohibition against maisir, according to Thomson Reuters Practical Law. Margin trading, day trading, options, and futures are considered prohibited by Sharia by the majority of Islamic scholars, according to Khalil Jamaldeen. Margin trading, because it involves borrowing money to buy what is being traded, involves interest payments in margin accounts. Day trading, because it involves buying and selling financial instruments within the same trading day, is not concerned about the underlying product or economic activity of what is traded. One source, Investopedia, states gharar is observed within derivative transactions such as forwards, futures and options, as well as in short selling and in speculation. Derivatives. Counsel and Andreas Jobst write that legal scholars have alleged that derivatives contain excessive uncertainty, gharar, and encourage speculative behavior akin to gambling, maisir. According to economist Faisal Khan, derivatives, essentially securities whose price is dependent upon one or more underlying assets, fail the tests of Islamically permissible by lacking materiality, i.e. a direct link to a real underlying economic transaction, and involving speculation. Furthermore, almost all conservative Sharia scholars have ruled that when applied to modern financial contracts, the prohibition of gharar eliminates futures, options, and some life assurance contracts. Taqi Usmani forbids most futures transactions because their delivery or possession is not intended and therefore the niyyah of the contracting parties is questionable. Investopedia states in Islamic finance, most derivative contracts are forbidden and considered invalid because of the uncertainty involved in the future delivery of the underlying asset. Khalil Jamaldeen writes that Raj Bala calls the short selling of stocks an example of common financial trading forbidden by Sharia law, forbidden because the short seller borrows rather than owns the stock shorted. Islam Qa describes it as not permissible in Islam. Taqi Usmani gives short selling as an example of an economic activity banned according to divine restrictions. According to Humayun Dar, CEO of a Sharia advisory firm, there is no dispute by all main scholars that short selling is haram. Jurist Yusuf Dalal Di Lorenzo notes in connection with injunctions against day trading that owning stocks for less than a day does not show a commitment to stewardship and ownership consistent with Islamic teaching. Focus Business Services of the UAE notes that the short period of ownership means day traders do not truly own what they trade, and furthermore pay interest, as marketable securities generally have a multi-day settlement period, during which time the underlying instruments, while cleared, are not formally registered in the name of the purchaser. As day traders do not wait for settlement to complete, they are using a type of credit cushion provided by their broker. Islam QA forbids at least the short selling involved in day trading. Khalil Jamaldeen includes margin trading as one of the activities prohibited by the majority of Islamic scholars, the reason being it involves borrowing funds to invest, and the lender of the funds charges interest. Moreover, losses can be greater than the amount borrowed, because margin trading amplifies the risk to the investor, increasing his percentage of debt or leverage increases. Defense and benefits. On the other hand, some Islamic finance practitioners and critics find benefit in at least some uses of derivatives and short selling. At least one scholar, Muhammad Hashim Kamali, finds nothing inherently objectionable in selling and using options, which like other kinds of trade, he believes, is mubah, permissible, in fiqh, and simply an extension of the basic liberty that the Quran has granted. Economist critic Faisal Khan points out the current relatively strict interpretation by ulama of hadith related to trade and commercial transactions have a wide-ranging impact on basic bank functions since virtually all financial instruments involve the interest rate in some way or form. Thus the current relatively strict interpretation of the hadith-related trade and commercial transaction would ban opposition by conservative Islamic scholars to use of derivatives as a form of gambling that violates Sharia law exposes the Islamic finance industry to risks of increased volatility when markets deteriorate, according to Weissing. Adil Knott, chief executive of the International Center for Education in Islamic Finance, asks, when does risk management end and gambling begin? One defender of the use of options in Islamic banking is Andreas A. Jobst of the International Monetary Fund, along with Counsel. Jobst writes that many Sharia scholars now accept the application of hedging of actual exposures as an essential element of sound risk management and acknowledge the opportunity cost imposed by a lack of Islamic hedging tools. Jobst argues that using derivatives for risk diversification contributes to the continuous discovery of the fair market price of risk, improves stability at all levels of the financial system and enhances general welfare. Specifically, issuing stock options to employees is a common way of increasing productivity. Use in Islamic finance. Short sales. Short selling has been forbidden by conservative scholars because it requires the selling of an item by the investor that they do not own. However, some Sharia-compliant hedge funds in at least one country with a large financial sector, the United States, have created a way to short shares of stocks that has been Sharia certified, according to Faisal Khan. It requires a down payment towards the shorted stock instead of margin, borrowed money. Another source, Irfan Nahim, a representative of a Sharia consulting firm, states that Islamic hedge fund managers have developed alternative Sharia-compliant strategies with two instruments, Salam and Arbun, being the Islamic alternatives for the conventional short selling. Nahim argues that the hadith, where the Islamic prophet Muhammad commands, "Sell not what is not with you," which is traditionally interpreted by Muslims as an injunction not to sell what you do not own, actually may refer only to the sale of items that are unique or not commonly available. If something is readily available, such as an instrument is in a short sale, then borrowing and selling is not forbidden, Nahim contends. Al-Gamal criticizes this practice as an imitation of conventional ribawi finance in synthesizing Islamic versions of short sales, as well as other instruments. Faisal Khan and Al-Gamal also complain that using a down payment rather than borrowed margin funds in shorting a stock is simply a workaround little different than the conventional process, but charging substantially higher fees. Derivatives. As of 2013, the Islamic derivatives market was in its infancy and its size was not known. The Islamic derivatives, or at least derivatives declared Sharia compliant, include swaps, and put and call options. According to critic of Islamic finance, Mahmoud A. Al-Gamal, one way the Islamic finance industry gets around prohibitions on the use of options is to use conventional banks/financiers as a buffer between the haram income and its Sharia-obedient customers, employing conventional banks as partners or advisors and paying them with the haram gains from derivatives. Swaps. Khalil Jamaldeen describes the Islamic swap market as being composed of two kinds of swaps. Versions of both of these two swaps, called the Islamic profit rate swap and the Islamic cross-currency swap, as well as a version of a derivative called the Islamic forward rate agreement, are offered by one Islamic bank, Standard Chartered Sadiq Malaysia. According to Harris Irfan, the Islamic finance market is awash with contracts for the profit rate swap. By 2010 they had become common enough for a global standard to be developed by the Bahrain-based International Islamic Financial Market and New York-based International Swaps and Derivatives Association. This standard, called the Tahawut or the Hedging Master Agreement, provides a structure under which institutions can trade derivatives such as profit rate and currency swaps, or as the ISDA/FFM describes it, is. Counsel and Andreas Jobst describe the standard as an innovative pan-madhab agreement spanning all 5 major schools of Islamic jurisprudence. It has strong parallels to the 2002 ISDA master and schedule of the conventional banking industry. Irfan urges Islamic financiers to use this Tahawut or hedging master agreement and benefit from the cost saving of its standardization, but lamented that it has not been widely used as of 2015. In March 2012 the ISDA and FFM issue another product standard, the ISDA/FFM bilateral riba, to provide an Islamic risk mitigation framework for the industry. Another hedging tool, but not a standard, is the Islamic Profit Rate Swap, Iprs, which allows 2 parties to exchange a series of profit payments in a single currency in exchange for another series of payments in the same currency. It has been described by the Islamic Bankers Resource Center as an alternative to the Ta'arruq Murabah and similar to it, except that the underlying assets it uses for the transaction are not actual commodities but the Mudharaba Islamic Interbank, MI, and it uses bayina contracts instead of Murabah. The Iprs involves 3 Sharia concepts, the wad, the bayina and the makasa. Iprs has been used quite a bit in Malaysia but its bayina contract is rejected in the Middle Eastern countries. A standard used to facilitate the Islamic profit rate swap is the Islamic Derivative Master Agreement, IDMA, issued by Malaysia's central bank, the Bank Negara Malaysia, in 2007. WAD. WAD, literally promise, is a principle that has come to underpin or to structure Sharia-compliant hedging instruments or derivatives that provide substitutes for conventional hedging products such as forward currency contracts and currency swaps. However, WAD has been called controversial, and its products criticized as mimicking conventional ones in Islamic and form alone. A double wad, literally double promise, is a derivative that allows an investor to invest in and receive a return linked to a financial benchmark, such as an index of interest-bearing U.S. corporate bonds, that would normally be in violation of Sharia. The investor's cash goes to a special purpose entity and in return they receive a certificate to execute the derivative. This involves a promise that on an agreed day in the future the investor will receive a return linked to the chosen benchmark. If the interest-bearing U.S. corporate bond index has gained 10%, for example, the investment gains 10% although no corporate bonds have been purchased. Several features of the double wad, allegedly, make the derivative Sharia compliant. So despite the fact that benchmark involves non-compliant investments, the contract is not bilateral, something forbidden by Sharia, because the 2 undertaking promised are mutually exclusive, and this, proponents say, makes it in compliance with Sharia. In 2007, Yusuf D. Lorenzo, chief Sharia officer at Sharia Capital at the time, issued a fatwa disapproving of the double wad in situations where the assets reflected in the benchmark were not halal, but this has not curtailed its use. Put and call options. Like the Islamic equivalent for short sales, a number of Islamic finance institutions have been using the down payment sale or urban as a Sharia-compliant alternative to the conventional call option. In this mode the Islamic equivalent of the option premium is known as a down payment, and the equivalent of the strike price is called the preset price. With a conventional call option the investor pays a premium for an option, the right but not the obligation, to buy shares of stock, bonds, currency, and other assets may also be shorted, in the hope that the stock's market price will rise above the strike price before the option expires. If it does, their profit is the difference between the 2 prices minus the premium. If it does not, their loss is the cost of the premium. When the Islamic investor uses an urban they make a down payment on shares or asset sale in hope the price will rise above the preset price. If it does not their loss is the down payment which they have the right to forfeit. A put option, i.e. where the seller has the right but not the obligation to sell at a preset price by some point in the future, and so will profit if the price of the underlying asset falls below that price, is called a reverse urban in Islamic finance. Sharif Ayub criticizes the practice of labeling what is effectively an option premium a down payment as creative but misleading. He points out that how and why their prices are calculated is very different. The down payment is intended as security for the financier, proof that the buyer has skin in the game. The premium in contrast is intended to ensure that, on average, the premiums paid to the seller exceed the losses from exercised options. The down payment is set as a percentage of the cost of the item being purchased. The premium has no relation to the price of the stock but is based on the difference between the strike price and the actual price of the stock in the market at contract maturity. According to al-gharar, most analysts who examine the differences between the Irbun down payment and the call option have concluded that the latter cannot be synthesized from the former. Faisal Khan quotes Ayub as describing the use of the Irbun down payment for a call option as extremely controversial among traditional Islamic banking and finance scholars.